Welcome to the Young Investor Podcast, where we break down complex financial and geopolitical topics into digestible insights for young and aspiring investors. I'm your host, Ollie, and today we're diving into one of the most profound and inevitable transformations facing our world, the demographic revolution. We're living through a moment in history that's never happened before. Populations around the globe are aging faster than ever. Birth rates are plummeting, and the economic implications are staggering. But here's the thing. Where others see crisis, savvy investors see opportunity. Today, we're exploring how demographic shifts are creating entirely new markets, disrupting traditional industries, and fundamentally changing where smart money should flow. Whether you're managing a portfolio, running a business, or simply planning for your own future, this episode will change how you think about the decades ahead. Let's start with the numbers, because they're truly mind-bending. Right now, for the first time in human history, people over 65 outnumber children under 5 globally. By 2050, 1 in 6 people on Earth will be over 65. That's up from 1 in 11 in 2019. In developed nations like Japan, Italy, and South Korea, the numbers are even more dramatic. Japan already has 29% of its population over 65, and that's projected to hit 38% by 2050. Meanwhile, birth rates are collapsing. South Korea's fertility rate hit 0.72 births per woman in 2023, far below the 2.1 needed to maintain population levels. Even the United States, long buoyed by immigration, has seen its fertility rate drop to 1.6. China, after decades of the one-child policy, is now facing a demographic crisis that will shrink its working-age population by 200 million people over the next 3 decades. What does this mean economically? First, the dependency ratio is skyrocketing. Fewer workers are supporting more retirees. In 1950, there were 12 working-age people for every person over 65 globally. Today, it's 9. By 2050, it'll be 4. That puts enormous pressure on pension systems, healthcare, and government budgets. Second, economic growth is slowing. Fewer young workers means less innovation, less consumption growth, and less dynamism. Traditional economic models relied on ever-expanding populations. Now we're entering uncharted territory. But third, and this is crucial for investors, massive new markets are emerging to serve this aging population. We're talking trillions of dollars flowing into sectors that barely existed a generation ago. So let's talk money. Where should investors be looking? Healthcare is the most obvious beneficiary, but it's not just about buying pharmaceutical stocks. We're seeing explosive growth in specialized areas. Chronic disease management is becoming a massive market. As people live longer, they're living with conditions like diabetes, heart disease, and arthritis for decades. Companies developing continuous monitoring devices, personalized medicine, and digital health platforms are poised for massive growth. Think about continuous glucose monitors that have revolutionized diabetes care. That market alone is expected to reach $18 billion by 2030. Companies like Dexcom and Abbott Laboratories have dominated the continuous glucose monitoring space, with Dexcom's market cap growing from around $10 billion in 2018 to over $40 billion by 2024. These aren't just medical device makers. They're becoming data and software companies that help patients manage their conditions long-term. Similarly, companies like Intuitive Surgical, which makes the Da Vinci robotic surgery system, are benefiting from the need for less invasive procedures that allow faster recovery for older patients. Medical devices for aging represent another growing market. Joint replacements, hearing aids, vision correction. These are all expanding rapidly. The global orthopedic device market is projected to exceed $70 billion by 2030. Companies like Stryker and Zimmer Biomet have seen steady growth as hip and knee replacements become routine procedures. And new technologies like 3D printed implants and minimally invasive surgical tools are making procedures safer and more accessible. On the hearing aid front, the recent FDA approval for over-the-counter hearing aids has opened the market to new players, with companies like Sony and Bose entering a space traditionally dominated by specialized manufacturers. Home healthcare is another fascinating shift. Most seniors want to age in place, not in institutions. This is driving explosive growth in home healthcare services, remote patient monitoring, and telemedicine. The home healthcare market is expected to grow at 8% annually through 2030, reaching over $500 billion globally. Companies like LHC Group and Amedisys have built significant businesses providing nursing and therapy services in patients' homes. Meanwhile, technology companies are creating smart home systems that monitor health, prevent falls, and enable independence. The senior housing sector is undergoing a complete transformation. We're not talking about old-school nursing homes anymore. Active adult communities that offer resort-style living for healthy seniors who want amenities, activities, and community are seeing massive investment from real estate developers. Publicly traded REITs like Welltower and Ventas have significant portfolios of senior housing properties and have repositioned themselves to focus on higher quality, more amenity-rich properties. Memory care facilities represent another critical niche. With Alzheimer's and dementia cases expected to triple by 2050, specialized memory care is becoming both essential and profitable. Companies like Brookdale Senior Living operate these facilities, though the sector has faced challenges with labor costs and occupancy rates that investors need to watch carefully. Here's an underappreciated angle: financial services for retirees. Traditional wealth management focused on accumulation. Now we need solutions for distribution. How do you make money last 30-plus years in retirement? This is driving innovation in annuities, longevity insurance, reverse mortgages, and retirement income planning software. Companies like Empower Retirement and Fidelity are developing sophisticated decumulation products. Fintech companies that solve the decumulation problem will capture enormous value. Even traditional insurance companies like MetLife and Prudential have shifted significant resources toward retirement income products as they see the demographic writing on the wall. Don't sleep on consumer goods and services for seniors beyond healthcare. This demographic controls the majority of wealth in developed nations. We're seeing growth in travel and leisure tailored to older adults. Companies like Viking Cruises have built their entire business model around upscale travel for seniors. Wellness and fitness programs for active aging are booming, with companies like Silver Sneakers providing fitness programs specifically designed for Medicare beneficiaries. Technology designed for ease of use represents another opportunity. Companies that can create intuitive interfaces and devices that work for less tech-savvy users will capture significant market share. Pet care is another interesting angle, as seniors are major pet owners and are willing to spend on veterinary care and pet services. Continuing education and lifelong learning platforms like Osher Lifelong Learning Institutes at universities are seeing increased enrollment as retirees look for intellectual engagement. One crucial point: this isn't happening uniformly across the globe, and that creates different opportunities in different markets. Japan is the canary in the coal mine. They're 2 decades ahead of everyone else. Japanese companies are pioneering robotics for elder care, multi-generational housing models, and policy solutions. Companies like Toyota have entered the healthcare robotics space with mobility assistance devices. Japanese pharmaceutical companies like Eisai have focused heavily on Alzheimer's research, with drugs like Leqembi gaining recent FDA approval. Investors can learn from and invest in these innovations before they scale globally. Europe faces similar challenges, but with better social safety nets. This creates opportunities in private healthcare, luxury senior living, and pharmaceutical innovation. European pharmaceutical giants like Novartis and Roche have significant aging-focused drug portfolios. Nordic countries are leading in digital health solutions that could be exported globally. China presents a unique case: rapid aging without the wealth levels of developed nations. This is driving demand for affordable healthcare solutions and technology-enabled care models. It's also forcing China to open up its healthcare sector to foreign investment. However, geopolitical tensions mean investors need to carefully evaluate the risks of Chinese healthcare exposure. Companies that can deliver low-cost, scalable solutions in China might find enormous markets, but regulatory and political risks remain high. The United States has the advantage of immigration to soften the blow, but still faces massive pension shortfalls and healthcare cost pressures. The opportunity lies in disruptive models that deliver better care at lower costs. Value-based care companies like Oak Street Health, which was acquired by CVS Health for nearly $11 billion, demonstrate the appetite for new care delivery models focused on seniors. The Medicare Advantage market continues to grow, with insurers like Humana and United Health Group capturing increasing market share. Emerging markets like India and parts of Africa have younger populations. They'll be the workforce of the world. Smart investors are looking at how these regions can serve aging developed nations through medical tourism, caregiving services, and remote healthcare delivery. Indian hospital chains, like Apollo Hospitals, have built significant medical tourism businesses. The Philippines has become a major source of healthcare workers for aging nations, creating opportunities in healthcare staffing and training companies. Let's talk about the bigger picture and the risks investors need to consider. Economic growth will slow. There's no sugarcoating this. Aging populations mean lower GDP growth rates. Japan has been growing at under 1% annually for decades. This could become the norm for much of the developed world. This means that high-growth investments will be harder to find, and dividend-paying, stable companies may become more valuable. Investors may need to accept lower returns or take on different types of risks to achieve their objectives. Government debt will explode. As pension and healthcare costs soar, government debt levels will rise. This could mean higher taxes, inflation, or both. Investors need to factor in fiscal risk when evaluating sovereign bonds and national markets. Countries with better demographic profiles, those with higher fertility rates or more open immigration policies, may prove more creditworthy over time. The fiscal pressures could also drive governments to make difficult reforms to pension systems and healthcare spending, creating political volatility. Labor shortages are already emerging in many developed nations. Fewer workers means competition for talent and upward wage pressure. Automation and AI will be essential. Companies that can't adapt will struggle. This makes robotics and AI massive long-term investments. Companies like Boston Dynamics, NVIDIA, whose chips power AI applications, and industrial automation firms like Rockwell Automation stand to benefit. Healthcare specifically will need to become far more efficient, creating opportunities for companies that can reduce the labor intensity of care delivery through technology. Intergenerational wealth transfer is another critical factor. Over the next 25 years, $84 trillion will transfer from baby boomers to younger generations in the U.S. alone. This will reshape consumer markets, real estate, and philanthropy. Understanding where this wealth flows is critical. Younger generations have different values and spending patterns. They prioritize experiences over things, sustainability over convenience, and digital over physical. Companies that can bridge the generational divide in their products and marketing will be better positioned. We might also see increased demand for estate planning services, trust companies, and family office solutions. Political instability could increase as well. Aging populations tend to be more politically conservative and less supportive of policies that benefit younger generations. This could create social tensions and policy gridlock. Investors need to monitor political risk carefully. We could see conflicts over issues like climate change, spending, education funding, and healthcare reform as different generations compete for limited government resources. Immigration policy will become increasingly contentious as countries try to balance the economic need for younger workers against political resistance to demographic change. So what should you actually do with this information? First, diversify into demographic-aware sectors. Healthcare, senior services, and aging-related technologies should be part of every long-term portfolio. This doesn't mean going all in on healthcare stocks. It means ensuring you have exposure across multiple aspects of the aging economy, from real estate to consumer goods to financial services. Second, look globally. Different countries are at different stages of the demographic transition. There's alpha in understanding these variations. Japan offers lessons about what's coming for other developed nations. Europe provides insights into how strong social safety nets change the opportunity set. China shows how rapid aging plays out in a middle-income country. The U.S. demonstrates how immigration can moderate demographic pressures. Emerging markets might offer higher growth, but with different risk profiles. Third, think longer term. These trends play out over decades, not quarters. Patience will be rewarded. The companies that are building infrastructure for an aging world today might not show immediate profits, but they're positioning themselves for structural tailwinds that could last 30 to 40 years. This requires patience that many investors lack, but those who have it will be rewarded. Fourth, don't ignore innovation. The companies that solve the challenges of aging, affordability, quality of life, independence, will generate enormous returns. The status quo in elder care is expensive, often low quality, and unsustainable. There's massive room for disruption. Look for companies using technology to deliver better outcomes at lower costs, business models that align incentives properly, and solutions that truly address what seniors want rather than what the system traditionally provided. Finally, consider the broader portfolio implications. Lower growth environments require different asset allocation strategies. Work with advisors who understand these demographic headwinds. You might need more international diversification, greater exposure to real assets that can hedge inflation risk, and a different mix of growth and income investments. The 60/40 stock-bond portfolio that worked for decades might need rethinking in a world of lower growth and higher fiscal pressures. The demographic shift isn't just a social trend. It's the defining economic reality of the 21st century. The investors who recognize this early and position accordingly will be the ones who thrive in the decades ahead. That's all for today's episode of the Young Investor Podcast. If you found this valuable, please subscribe, leave a review, and share with anyone who's thinking about long-term investing. You won't want to miss it. Until then, I'm Ollie reminding you, the future isn't something that happens to you. It's something you invest in.